You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Well, welcome back from lunch. I hope everybody got their appetite taken care of. We're going to continue the conversation from before lunch, and we're going to take it a little different tact. Mark Odo and Chris Hausman are back up here, but we're also joined by Portfolio Manager and COO Rob Swan, as well as Director of Research, Michael Wakefield, who's also a Portfolio Manager and also leads our product development initiatives. Here we're going to talk more about the multiple asset class structures, or asset classes and structures, and how we could apply the DRS across also custom overlays and how we can put that to work in a variety of different ways. And so when you think about Swan, the way I would start is to look at us as an organization that's really an overlay manager and think about what it is you're trying to accomplish. What's the mandate? You know, what are you trying to solve for the portfolio, avoid or enhance? And then we can, through a conversation, look at portfolio construction and a variety of options to put money to work on your behalf. So with that, Mark, I'm going to let you lead off.
Okay, great. Thanks for rejoining us here. So yeah, in the previous session, we kind of laid out the basics of the defined risk strategy, the kind of key core components. You talk about the core, equity, the hedge, and the income. And at the end, someone kind of asked the question about different directions we can take it. Yeah, we could take this basic concept of defined risk strategy. We could do two different things. One, we can roll these various strategies up together at more of the portfolio level and get more of a global asset allocation type solution out of DRS type components. Alternatively, what we can also do is break these three things down into their constituent parts and look at them each individually. So we're actually going to start there. We're going to talk about breaking the DRS down in its three components. Again, I got this concept of the three-legged stool, and there's three elements of this. There's the equity, the hedge, and the income. And the flagship product, our mutual fund, as well as our separate managed account, is, again, kind of our best guess solution as far as, like, if we were just to buy something off the shelf without any customization, this is what a good hedged equity solution long-term play would look like. But we can also break this thing down and have some fun with it. If you think about each of those different components, there's like different risk dials there. There's ways we can either turn up or turn down the risk and get in either more aggressive or more conservative play, depending upon the objectives of the client. So with the first element, the core equity, I'm going to ask Micah to kind of talk about some different things we've done applying the DRS to different types of underlying market exposures while still hedging away the systematic risk.
Right, so thanks, Mark. Yeah, so what he's referring to is our overlay approach that we have here at Swan. In essence, at Swan, we're an overlay manager just in a lot of different ways, whether it's an overlay over the passive ETFs with like our mutual funds that we've already talked about or in our SMAs. But we also do custom overlays. With the first type of overlay approach we'll take is just very similar to what you see across on our other products, where we can do an overlay with the S&P 500, with U.S. small cap, with foreign developed markets, with emerging markets. And then also we have one we do as well with high yield bonds, with HYG, with that ETF as well. But I think where kind of the strategy gets really powerful when we think about those dials and moving them up is kind of in the custom overlay space, where we're able to do a lot of different things, achieve a lot of different outcomes depending on what you're trying to do for your client. Because, right, not every client has the same objective, and it's about you trying to help your client reach their objectives. And so the great thing about the power of customization with options is not everybody has the same risk profile, right? So we can try to change those dials to fit them a little bit better. Maybe they can take a little bit more risk. It's about trying to find something that helps them stay invested and achieve as much outcome as possible to the upside when they occur, but have them in a place where they're comfortable with the downside as well. So what that kind of looks like is shown here on this next slide, where when you overlay a portfolio, perhaps you have some managers that you really like in the equity space. What we then would look to do is kind of come in, take a look at those managers, see how they tend to act, do some correlation analysis and say, okay, well, the best and most cost-efficient hedge that we probably can do managing it the same way that we manage our hedge across on our other strategies, we would then apply, and that's kind of that red band where we're going to overlay that hedge across that equity portion of the portfolio, the portion that you're looking to. And what that ends up creating is you can create all kinds of different risk profiles, but very unique stories with your clients as far as to have things to say, we can either come with an approach to do a full overlay over your entire portfolio and shift the risk there down, where you can take more risk in the managers you're picking, maybe something that's more aggressive, you want to do a little bit more, but you want to also take away some of that market risk. That's one approach. Another approach, as we look at this next slide, is kind of there in the middle, concentrated positions. So we'll have clients, maybe a high net worth client has a large position within one particular stock that they can't really trade. Maybe they're an executive of that company. What we can look to do is do a custom overlay over those concentrated stock positions that can help them reduce the risk that they have there, either on the market risk level or even at the individual company level, depending on what's available there from in the options market and to hedge. And that can help them have a more really more tax efficient, perhaps strategy where they can still hold that position, but perhaps have a lot less risk and they're not having to sell something and take some of those gains. And so there's a number of different ways that we can do custom overlays, really, as you see from the spectrum here from left to right, from doing more conservative overlays, more similar perhaps to some of the things we do, to or even more aggressive ones, more individualized and more customized. Or we'll even do things where we'll work with clients where they say, you know what, I have a client who has a particular risk that he wants to cover over a particular time. Can you do a custom hedge for us? So we'll look at doing that as well. Lots of different ways you can look at a portfolio and say, okay, if this is the risk you're comfortable with, here's a number of different options we can show you and the different costs that would be associated with that for hedging the portfolio. And to kind of get into more depth of what we can do on that level, Chris, I'll let you talk a little bit more about what we do there on the hedging side.
So what we're trying to create when we employ options for hedging is what? Create a truly negatively correlated asset. What are the goals for hedging? Number one, reduce volatility. You want to reduce maximum drawdown. You want to reduce correlation. You're trying to improve the asymmetry of returns. And then the most important one is what? Don't lose money. So this is just a table of, well, what's available out there? What are some of the more popular strategies? As everyone knows, we employ a put, but there are other strategies out there that could, like Micah said, well, what does the client really want? Put spreads will do a certain zone. They don't have the convexity of long puts. Callers, it's a more traditional where you're buying a downside put, selling an upside call to hedge that, to fund that. And then put spread callers is another variation of a traditional caller. So this is just a sample of, okay, not every option strategy is going to work in every single environment. Some work better during sharp corrections. Some work better during bear markets. Some work better for the grind. Again, what are you trying to achieve, right? Is it left tail that you're protecting? Is it moderate downside that you're protecting? Is your goal income generation? Is it moderate up? Or is it right tail? Because we have to deal with right tail. Everybody in this room right now is feeling the pain trade, right? The market keeps going up and we're like, when's it going to stop? Or maybe you want it to keep going. But at this point, people are definitely thinking about, how do I hedge my portfolio at all-time highs? And with everything that we've heard today of the risks that are, embedded in the system. We don't know when those are going to show up, but they are out there. This is the same one we looked at that we covered previously, so I'm not going to go into it. Again, my takeaway is this is more there's a lot of different things that we can do. So education is paramount. The more people are better educated, that means the more comfortable they are with the strategies. And that means they're going to have more options, right? They're going to be able to select the proper strategy or construct the proper strategy. And that's what we do in the overlay program for what their goals are, because everyone has a different risk tolerance in this room. If you interview 10 traders, you're going to get 10 different methodologies of what they do and what they look at, even though they're all successful. But so it's just a difference. It's what what is inside and what your risk reward tolerance is.
Right. So I think on this next slide here, all we're kind of saying with this custom overlay approach or with the Swan overlay approach is creating that band there that we've done in our other strategies, which is create a target return band for that portfolio or for those holdings that a client might have. And then as we look at the next slide, what we seek to do with the custom overlay approach is we can create different, in essence, levels, different risk profiles there, different bands there. And so we've taken this approach in a number of different products where we're saying, okay, if you're okay, as you can see kind of on one of those curves, you start to get a little bit more of the upside on the right side. But on the left side, what does it mean if the market sells off? Well, you'll participate a little bit more. But then as you see with our normal strategy as well, with the gold line there, it also defines and goes and flattens out there as it goes. It's just, in essence, if you're spending a little bit less on hedging or you're hedging a little bit further out of the money, it just means you're going to take a little bit more of that volatility as the market moves down, but it also means greater up capture to the upside. So I think what we're going to do next, Mark, is look at a few of those products, right?
Yeah, we've got a specific example, a great case study of this, and we touched on this just before we broke for lunch. I'm going to turn it over to Rob because we've actually been running this strategy, as I mentioned, since 2015, but have since then made it widely available because it met our goals. It was successful, and it did what it was supposed to do. So, Rob, if you could add a little bit more color to our growth fund and its intent and how it's put together and how we've changed those risk dials.
Sure. So, can you go back to the previous chart here? I think it's really important to understand that as an overlay manager, we have the ability to kind of customize these different risk levels. So, as Micah said, think of this as in terms of dials. If you were to buy an insurance policy, you could buy a high deductible insurance policy that basically would take on more risk, but it's going to be less drag. It's going to be less cost for you. If you never need it, that's the right way to go. And so in a long, extended bull market like we've had, a growth approach with taking a little bit more downside risk might allow you to kind of accelerate or achieve higher levels in a shorter period of time as the market's going up. We launched a growth fund that was really based on, as we talked about, running something back for several years, and that was in turn based on something, Mark, you're going to talk about, which is our collective investment trust. But it's really being able to kind of dial up that risk level, and maybe even with your input. I mean, if it's a custom overlay, then you might have an opinion on the market that I want this type of a deductible. And so it's not a one-size-fits-all. The growth fund that we launched at the beginning of this year is using SPY instead of select sector spiders, the equally weighted select sector spiders. So it's got more of a growth tilt. We basically have taken the hedge, same size hedge, so we still have that same bottom of the curve, meaning it's going to cover 1-for-1 the equity losses beyond a certain level. That's what we call our defined risk. But it's moved it farther out of the way. And so maybe instead of having a 7 to 10% kind of downside theoretical on your hedge plus your equity, maybe you're in the 10 to 13%, or if you even want more, we have the ability to move it out of the way even further. Now, with the growth fund, in addition to using SPY, which is outperformed this year and over the past several years has outperformed, and in terms of moving that hedge farther out of the money, we also supplement it with additional synthetic upside using call spread structures, which gives us kind of a beta kicker on the upside. So when you combine all of those three, and this is a perfect environment this year for the growth fund, we basically, I think the market kind of year to date is up in the 16 and some odd change, and the growth fund is up somewhere around 13.8. So you're getting a lot higher upside capture ratio. Now, what does that allow you to do? Well, if you basically let the market keep going up and we go up another 16%, then we would expect similar type of performance. But it gives us opportunities. If I use a climbing analogy and you basically are able to climb and not knock a piton into the wall, then you get some gains and you can use those gains, and we have used those gains to shore up the hedge to basically lift that up a little bit. Using some of those gains, we might give up a little bit of upside capture ratio from here, but it allows us to kind of lock in some of those gains into a year. How can we do that? Because we got a little bit of money in our pocket. And so being up, 13.8%, out of 16, or 80% of the upside, that can potentially provide a way for you to incorporate that strategy for maybe some of your more aggressive or growth-oriented or younger clients, and mix that in with our flagship strategy, as well as including it with some of our other asset classes to really provide a total range of solutions for a different set of risk levels. And that's the basic concept with the growth fund. So I'm not sure if we know, well, somebody knows, not me, but all the platforms that we're currently on right now, we're working to get that fund available to you guys wherever you're at. And I believe it's already available at TD Ameritrade, Schwab, Fidelity. I'm not sure about LPL, but I think Justin Starnes could probably, or Jamie Atkinson could give you guys an idea of where if that's available to you right now.
Okay, great. Yeah, and what we have up here is our internal accounts that we ran on the strategy with our own money as kind of a guinea pig for this thing. And what's interesting is, yeah, we started this thing out in early of 15, and what's one of the things that happened in 15? Well, there's that big sell-off in August of 15. How did this thing do? Well, it did a little bit worse. But then we had 3 years of up. Well, it did better. So if you want to just think about it as it's a maybe racier cousin or a little bit more aggressive cousin, that what you see here is just those risk dials turned up one way or the other. So that's one thing that we could do is take this concept of the defined risk strategy and treat these components differently and dial them up or dial them down. But the other thing we could potentially do is roll them up. We can take these different asset class solutions and create blended portfolios for them. And we're going to have a couple of different examples to discuss here. The first is our collective investment trusts, the CITs, which is built for retirement space. We also have a couple of different ways that you can access our models that I'm going to discuss in a second here. But with the CITs, I'd actually like to introduce Joe Gordon because we helped develop these with Joe. Can you? Yeah, there he is. We worked, Joe and I, well, Joe came to us, or we came to him, trying to solve a similar problem with what we saw in the retirement space. I mean, don't get me wrong, target date funds, life cycle funds have been a tremendous innovation, but they were still following the same kind of basic risk mitigation techniques that everyone had always used for so long. And the problem was, well, of course, the global financial crisis here. If we look at the GFC, what we have here, let me explain this. This is a drawdown graph, and we see the various vintages of the various target date funds. Now, the fact that the very aggressive ones are down a lot, that's not too much of a concern to me. But what really concerned me when I look at this is the yellow line, because that yellow line is the target date vintage for 2000 to 2010. Which was, I mean, look, my father retired in 2007, right? So he theoretically should have been in one of these types of portfolios. And when they sold off, they lost, on average, over 30%, right? So kind of getting back to those points that we talked about previously, it's like, look, when you need it the most, that traditional diversification type of thing has failed. So what did we do? We put together a series of 5 different portfolios in conjunction with Gordon Asset Management, Alta Trust, offering people a range of conservative to aggressive, again, kind of modifying all these various dials here. And what do those actually look like? Okay, so there's a drawdown graph. Well, here we go. Here's that kind of spectrum of 5. The middle one is kind of what you would expect. It's very basic. It's an asset allocation, but using various asset classes with the defined risk process. Now, the more conservative ones, we did put some bonds in there. People like bonds, and sometimes in short-term sell-offs, the bonds still are the best place to be over shorter periods of time. So, we've got that more conservative side. Now, with the aggressive side, as we go up the ladder, what we did is we introduced some more aggressive core types structures, right? So that'd be like emerging markets. So it would be the NASDAQ Qs we've hedged as different illustrations of how we can play around with the core. But then we also did some of those other things that Hausman mentioned, which is like backing off the hedges a little bit, giving us more upside capture at the expense of less downside protection. And we're trying to get this nice range here. Now, how does this look like when you compare it to the lineup of target date funds out there? Well, what we see here are those 5 funds versus a range of vintages. And yes, these are more conservative, right? We got options here which are, by their very nature, better suited for people who are in or near retirement. But on the flip side, we also have the risks here. We have the standard deviations of these things, and you'll see here, we are also tilting towards more conservative outcomes here with the CITs. This is just one illustration of what we've done to form portfolios here. We'd certainly be happy to talk about them in more detail. And again, Joe's been a great partner, and you can add some color to it as well. But this is just one illustration of how we can roll these things up into a total portfolio. We got a couple other examples here. I'm actually going to pass this over to Micah here because he's got lots of the next slides to talk about the risk-wise models and then our solutions program.
Yeah, so with the CITs, it's really a great solution as well if you have any 401k business as far as maybe smaller 401k plans. There's different ways and different platforms we can get that on. So that's kind of a solution there on the qualified space. But on the other space, so if it's taxable, Riskalyze has a model store. We have our models on there where we're taking our 4 funds, well now 5, and we have, it's kind of a good solution. Say if you have maybe a big client who they want you to work with their grandson, or maybe at the smaller accounts. At the smaller account level, this is kind of a good simple one-click solution that's available there at riskalyze.com. And so what we did there is we took our strategies and we basically kind of came up with a global diversified hedged portfolio there using those 5 funds. And so there's three models that are showing now, but we're just creating a fourth that should be available in the next week that's going to include that more aggressive growth fund that Rob was just talking about. So those end up looking a little bit like this here from the 3 that are, do we have 4 up there? Just the 3. Yeah, the 3 conservative, moderate, and aggressive versions. And so it's just taking a little bit more in the more aggressive asset classes like emerging markets and small cap as you get more aggressive and a little bit less. But they're usually mostly 2/3 U.S., 1/3 foreign. And then, of course, that's depending on whether it's emerging or foreign developed. But they're very conservative as it relates to Riskalyze scores for the most part, for those of you that use Riskalyze. But there's more information there at Riskalyze. You want to learn more about those models. Those are kind of, I think, a good way if somebody has only a $50,000 account and you're like, well, I could put them in a lot of different things, or I could kind of just put them in something that is going to be hedged and hopefully do well across all kinds of different market environments. But then, taking these concepts a little bit further, what we've done here with what we call our solutions program is kind of take these concepts and expand them to an overall holistic approach with portfolios, is to not just think of this hedge strategy as the only game in town. We do think that it's a great way to kind of approach equities and compared to buy and hold. But we wanted to build out portfolios that were really across the board based on some key investment principles that we think should be there when you're constructing portfolios. And it's these things here. We want to, of course, start with what we believe is really important to think of: market risk, trying to avoid those large losses, right? But we also wanted to look at diversifying across not just asset classes, but strategies and styles. We wanted to minimize volatility because, of course, if you do that, hopefully you're going to minimize some of the behavioral biases that tend to occur with investors. And also we wanted to look at things and say, you know what, it's really important to try to minimize taxes and costs as best as possible when you're looking at different things in constructing a portfolio. And of course, we wanted that to be a rules-based process. And so what we did with the solutions program is we kind of took a look at the core and satellite approach, but then we kind of worked around it and redefined a little bit. Instead of, the traditional core and satellite approach is to say, take your core and have it all in stocks and bonds, and then maybe have a few small satellite positions around that. We believe what hedged equity allows you to do is, because if it's reducing your risk, you can take a larger core position in equity as hedged equity, and you can take a much smaller position then in fixed income and actually take it from the core to the satellite, right? And especially with where things are in the fixed income, and probably where they are going forward, this is pretty, we think, an attractive approach where, in essence, what we try to do is we take our core as our hedged equity approach, take a globally diversified portfolio, which is over 5,000 securities, across those passive ETFs that are in the U.S. markets and the foreign markets, and make that the core. We hedge that in the same type of ways that we're doing in the CITs, where you can hedge it either conservatively or moderately aggressive or aggressive and so forth. And then around that, we want to build some of these satellite approaches with smaller positions that are going to help diversify it and help provide some different styles and things. And so that's where we introduce some things like fixed income, real assets, or real estate, and even tactical equity. We think tactical equity has a place in a full portfolio, but on a smaller level, because the weakness with tactical equity is if it's really wrong and if it's timing based or trend based, you don't necessarily always avoid some of those large losses. So it's great to be risk managed like tactical equity is, but you don't want it to be your core, because if it doesn't work out when those times when, of course, do come where it doesn't, you don't want that to happen. And so it's a straightforward process with how we built out these portfolios, and then I'll give a quick example of it. Just like with our strategy, as Mark and Chris talked about earlier, we take this approach where we're going to passively invest in a core diversified equity. We're going to actively manage that hedge on those assets depending on the risk profile. And then we're going to look to generate some income to help try to cover the cost of those hedges. And then that last kind of key part to make it more of a full portfolio is establish some smaller satellite positions. We want those to for purposes of diversification. We want to address inflation with real assets. We want to reduce volatility. And so what you see here is actually probably pretty similar to what we started out when I was talking about our custom overlays, right? It's a similar graph where we're going to take a core portfolio, we're going to overlay that with a hedge, and that's kind of the red portion there. And then the satellites that we have, we want them to be risk managed. We want to be considering those principles that you need to when you build out a portfolio. but we also want them to be providing some diversification of strategy and style. So with this example, I think it kind of comes back to the first point I made, was that we're, in essence, an overlay manager. We're not just an asset manager. We're agnostic to the underlying. We can take this approach with having a hedge, generating some income to help provide for that hedge, being able to adjust those dials as we looked at, and create all kinds of different products that can really reach across the spectrum depending on the client's needs and their goals and their outcomes.
Rob, did you want to add anything to the solutions program? I thought you had a few comments.
Well, I do have a few comments. So Mike has kind of gone through some of our approach on the portfolio modeling side. I mean, I'd like to maybe make a couple comments about the solutions program in general that goes beyond that. You'll probably be hearing in the near future, that we are really going to be rolling out what we call our Defined Risk Strategy Solutions Program, which is not only providing a variety of these models and a more customized approach, a total portfolio type of approach for your clients, for your use, but we're also basically looking to partner with David Shepard was talking about really your clients and basically partnering with those clients. And so our clients are really you. The investors may be your clients, but you are our partners, and we are really looking to apply our resources in-house, both from an investment management point of view, a technology point of view, a sales and marketing point of view, a business development point of view, to really invest in your business, to basically not necessarily providing money, capital for you, but actually investing our time and resources to help you to differentiate yourself, to do client meetings, to basically be more like white glove service treatment, to really help your business, your specific needs. And I think that these portfolios fit directly in with that type of more holistic approach. I would also say that in some cases, if we're talking about your favorite long-only equity managers, Mike has talked about how we basically can come in and do a correlation analysis, identify that the managers that you're choosing, it might be 20% emerging market, it might be 50% U.S. small cap. So we can use the building blocks of our strategy in these core asset classes to basically create that hedge overlay on top of your existing managers. And to me, it's a very interesting concept, given that those managers have to worry in general about the downside, the major downside. It probably affects their decisions because they have to worry about that downside. And if we're taking that away from them, then they can really concentrate maybe on what they're freed up, what they should be doing, which is try to outperform the market on the upside. So I think it gives, in combination, by taking that weight off their shoulders, it gives, I think, the whole portfolio a chance to really provide some significant outperformance. Last thing I would say is regarding Mark, what you were bringing up regarding the target date funds and the 2009, 2010 target date funds losing over 30%. I've seen numbers recently that shows the same thing is going on right now, and maybe it's even worse because fixed income is so much in the toilet in terms of the yields that when you're talking about 2%, most people are reaching for that yield, and the average 2020 target date fund is investing over 60% in equity. So individuals who think that they've got some conservative portfolio right now are going to be in for a rude awakening when they find out that in the next bear market, and as Danielle says, this could be very big, don't know when it's going to happen, that's not really going to be acceptable. They're going to be going back to work for that. So our approach is not subject to those same types of risks associated with reaching for yield. And we think that this portfolio, our overlay, the solutions program, these different approaches with hedged equity as a core solves an awful lot of problems and maybe providing, I joke and say, modern portfolio theory is dead or is terminally ill, and this type of approach can provide some kind of a cure to that reliance on something that maybe has worked over the past 35 years, but with the yields being down, sub 2 type of ranges, that's not going to deliver the same type of results.
We've got some time for questions here. We're a little bit ahead of schedule, so if you want to get the next speaker, ready to go, that's great. But that being said, Tom, if you want to ask your question now, I think that was a fine time because it does kind of. Tom asked me a question during lunch about turning the risk out and different ways to access the core equity exposure. He had a thought that this is probably an appropriate time to ask it.
You guys are obviously doing it more knowledgeable than I, and you know what you're doing with your option writing, but I'm wondering if it's a cost-benefit or risk-reward kind of ratio with the premium writing you're doing to bring in that premium income to offset the cost of the puts, hedging with puts. Wouldn't just buying some calls to ride the market do something similar with a lot less moving parts?
Well, in an up market, sure, and that's kind of what we've constructed in the growth fund, and some of the CITs have that. So the income trades are a separate component that, trying to defray the cost of the LEAP hedge. But you're right, if the market's going up, just buy calls or sell puts. It's as simple as that. So I think, but that goes away from our core strategy here and what we're trying to do over a full market cycle.
Right, I just add that in down and flat markets, that's where you still kind of want that to come along. Because if you're buying calls, obviously they're going to have some waste away. So in the example of our growth fund, there is that, maybe there can be a little bit more drag, obviously, from if we're doing some things on the call spread side and having those kickers. Those are more to kick in where if the market moves up more than 10, 15, 20%, that's really going to add some beta that's really going to help out with that up capture. But if you're going down or you're flat, then there might be a little bit more drag. But the drag isn't really that different as well if you're kind of backing off the hedge a little bit. And I'd say what's kind of good about the way it's being structured that way is what do markets tend to do from what we know historically about over the last 80 years. They tend to go up more than 10 or down more than 10. Occasionally they will be flat. I think there's been, I think 7 or 8 years that have been in between +4 and -4 since 1928. 2 of them have come this decade, and one was just almost a third last year, -4.3. And if you look back, there was 2 in the 1930s, there was 2 in the 1960s, and there was 2 in the 1980s. So I think this was 2, 4, 6, 8. Yeah. So will we continue to see more of those? Obviously, that's unknown. I think if it does happen, that's why it's important to have that other key part of the component of the strategy. That whether the calls they're going to have that decay, we want to be able to have something that also fights that as well.
I would also add in that one of the things we're not going to do, as Chris indicated, is use leverage in these positions. We've seen what can happen. It's obvious to us. It's why we don't use leverage in the strategy. Sometimes you're going to want to be selling calls. Obviously, if the market's going down, the call premium is going to be helping you. Can we tell whether the market's going to go down in the future? No, but we can, as Chris said, we can be coming into one side or the other, taking our profits off of one side, and maybe we just have our call on, the market reverses, we take that on, we re-enter the trade. We are not constrained by being a systematic strategy where we sell this exact amount on this day, regardless of what's going on. And I think that our active management, while maybe it doesn't seem like it has done a lot, sometimes we want to say, thank you would be appreciated even in 2018 because, we lost about 200 basis points on our income trades, this option writing, calls and puts. And it was a difficult year last year. And I won't name them, but if you go and look at some of our competitors, there was, orders of magnitude larger losses than what we're seeing. And so losing 2% last year in 2018, we never like to lose 2% when that is supposed to be helping to offset the cost of the hedge. But buying calls, I'm not sure, unless we could have timed that perfectly, if that was the only thing we would have done, whether we would have ended up in any, better scenario last year.
I just want to add one thing about Q4 2018 is there were a lot of other programs, Condor programs, programs that were leveraged, and they had 20 to 30% drawdowns in 2018, just in the fourth quarter. So I think 2018 has been a good year. If you go to Morningstar's options-based, it's the second fastest growing. The fastest growing in the last 2 years, and now I think it's the second largest or fifth largest in the alternative category. So there are a lot of options-based funds out there, and what's happening is we are starting to see, okay, where's the risk in all these different funds? And when you see a product that is supposed to be defined or limited risk through the structures that they're employing, and they have 20 and 30% drawdowns, and what is really going on with these strategies?
Yeah. We put together a fun paper, I don't know, I thought it was fun, but
We have a weird sense of fun.
yeah, man, when we get in the party, it's crazy. Yes. Yeah, it's called Know What You Own. I mean, House talked a little bit about the whole options-based category growing a lot, but people kind of treat all those strategies as being the same. It's like, oh, they use options, they must be the same. I mean, that's a very naive way of looking at it. I mean, it's like saying like, oh, it's a stock fund, it owns stocks, they're all the same. It's like, no, the instrument's not the same. It's how you use these instruments. And kind of the approach, he says, like there's kind of three primary strategic objectives with an options-based fund. One is hedging, one is income, and the other is just like pure alpha, pure trading. And you really, before you even invest, you really have to understand what each of these guys is trying to do, and then more importantly, how they're going about doing it. So that paper is meant to provide a little bit of guidance as you're trying to navigate through those close to 200 funds in that category that all use options in different ways. And we do have a little bit of time here for other types of questions. I mean, we could talk about some of this specific stuff with, rolling it up or breaking it down, or we could talk about any of the various elements to the defined risk strategy.
We talked. You guys talked a little bit about, as it pertains to the hedge. We talked a little bit about the moneyness of the options that we look to use. Can you speak a little bit about the duration of the options that we look to use in the hedge and why? There's obviously a lot of different time frames that we can look at in that marketplace.
Okay. Yeah, I mean, I'll start off, and then House can go into deeper detail. I mean, we do, by design, use options that go out for a very long time, right? They go out for 2 years. Now, what's one thing that all options have in common? They all expire, right? They all get to that point where they are worthless. It's use it or lose it. But there's also no rule that says you have to hold it until expiration. So one of the things that you'll find that's a little bit unique about the way that defined risk strategy uses is that we will buy these options for a long time period, usually about 2 years or so, but we'll only hold them for about half their life cycle. And then we're able to sell them and get some money back for them before they expire. And this is one thing we do to kind of minimize or mitigate the carrying cost of the hedge. Now, the other advantage of that is, and we touched on this real briefly in the previous session, is that sometimes when the markets go really bad really quickly, it becomes too expensive to buy a hedge at that point. If you're waiting until the warning signs, the warning lights are blinking, it might be too late. So the other advantage of having these long-term hedges is that we always have them in place. So when things do go wrong, we're not panic buyers and having to buy at the absolute worst time. So that's why we do things the way we do. And I'm not sure if you guys have any other additional color you wanted to add to that.
I would like to, before I turn it over to House, just one comment. I like to think of it in terms of insurance analogies. I mean, the last thing you want to do is to go out and buy health insurance that basically expires in 3 months. Whatever kind of existing condition that you may have, or you're right in the middle of some event, and you're going to have to go out and re-enter the market. Your existing insurance might have covered you, but you're only halfway finished with whatever is going on, and you're going to have to pay for the rest of the cost of your heart bypass surgery by going out and finding new insurance. By us buying the longer term insurance, we're never under any kind of duress to basically be paying up for that insurance that Mark's talking about. So we can choose the time on when to sell high on the hedge and to take advantage of buying low using the excess profits to be able to buy more shares. And when the markets go back up, we end up getting a higher upside capture ratio because we bought all those extra shares at a low price. And so buying something like that is more like airlines hedging their long-term fuel futures. They're not typically going to go out and try to hedge next week, or 1 week option on fuel costs. They're going to be looking to stabilize something over a longer period of time. And those long-term hedges depreciate less, as Chris indicated. If you total up the depreciation of the shorter-term options, it's actually a higher carry cost. It's like going out and renting your car from Avis every single day. You might think that $20 a day is cheap, but multiply that by 365 and you end up with a higher cost. There may be some benefits. If I'm going to get on a plane and I'm worried about that, maybe I buy $5 worth of insurance or whatever, and if it's a lottery ticket, if it pays off, it was probably worth the $5. But it's not a good long-term way to protect your portfolio. If you need to drive a car every day, go out and lease a car or buy a car. It's way cheaper than renting it from Avis.
I'll just sum that up, what I said previously. Reliability through a full market cycle. No long put program or put spread program has proven that. Kind of what Rob just mentioned, I call it the stair-step approach. If you're engaged in short-term hedging and the market goes down 5% every quarter, and you just move your hedge down 5% every quarter, we all can add that up. What's that going to be at the end of the year? So that is the difference maker. We just have not had a full market cycle in the last 10 years. Those are some of the challenges we live with every single day. Like I said, no option strategy covers every single thing. And the most important thing is interview your client and know exactly what are they trying to do. And if it isn't our flagship funds, then we have a series of overlay products that can custom tailor to anything.
Yeah, that's where I would just add, if it's an opportunity, maybe a custom, and we've done some proposals for people that had a client that came to them and said, I'm just really worried for the next 12 months with this particular part of my portfolio, can you do something about that? Then we will look to do something else for them there and show them a custom proposal, usually with about maybe 3 different choices to try to match that risk profile to say, okay, they say they don't want to lose more than 10% over the next 12 months. We can customize the hedge to that person. But as it relates to our strategies, yeah, exactly what Chris was saying.
Yes, sir.
So when it comes to y'all's overlay strategies, obviously in doing business with you guys in the past, one of the keys to success is having an options market that's liquid enough. So I would assume that there's some limitations to obviously what you're, like as an example, one area that I would love to have y'all strategy work with, and I doubt the option market is actually liquid enough, is the public trading. Extremely volatile, you capture a lot of the downside. But can you maybe talk a little bit about what are other areas outside of what you guys already have,
Sure,
products in that you could further extend?
right, and thanks for bringing that up because it is a good point. On the custom side, there obviously are more limitations. Even if it's a concentrated stock position, we can't necessarily apply the DRS on every concentrated stock position. We can do something that there's going to be some basis risk with it, right? But maybe not direct. And so what I mean by that is if it's a big blue chip stock, we're probably not going to have any trouble there with the options liquidity. If it's, say something like Wells Fargo or, Apple or, some kind of, really big stock. But if it's something that's more esoteric, I mean, we've had some people come to us for something custom that's not even, like a major stock. What we'll look then to do is to provide some analysis to say, here are your other alternatives and options to try to reduce your market risk. And that's where we bring in our correlation analysis, is we try to find something that does have options liquidity that is extremely highly correlated. As was pointed out earlier, we know that correlation doesn't always work and it sometimes breaks down, but it's kind of the next best thing. You just have to take on basis risk, and basis risk being that you have some risk that you're hedging with something that's a little bit different than what you're actually holding and underlie. So there are some limitations there. In the case of what you're saying, it would be kind of fun. I don't know, we have this weird sense of fun up here to look at the BDCs and say, okay, what do they act like? What in the options liquidity space, so to speak? I don't know if you want to add anything to that from a liquidity standpoint.
We can outsource the liquidity. We have excellent relationships. Sometimes it's more challenging than others, kind of like the products that you mentioned, but it's out there. It's just a matter of finding it, and we're in tune with liquidity providers and our relationships, and that's how we've been able to get these custom overlays done.
I would also add, if you came to us and said, I've got a bunch of Google stock, then we could obviously go out. Google would have plenty of options liquidity for us to be able to apply our full-blown strategy. You may want that. You may actually want that, and you may want it in a growth type of mode where you move it out of the money. But if you're really looking at covering systematic risk, which is market risk, and you're not really worried about Google not doing what they do good, then if you were to hedge Google with the S&P 500, maybe that gives you the basis risk, but over this full market cycle, you would have been doing better. It still would have covered a substantial portion of the drawdown that Google experienced during 2008, but you basically have less drag on the way up. And so we would encourage you to reach out to us. We have that kind of conversation with you in terms of how to do that. Now, why would you use something like S&P 500 versus Google? You may have a concentrated position, a client that's not able to, let's say, be trading, and you can't buy a hedge on something if you're an executive at a company and you've got that particular stock. And so this gives you the ability to maybe do something in that industry or more systematic in nature instead of just sitting there naked in that stock with full exposure.
I think we probably have time for one more question, although I know that John Root has an announcement he likes to make too about the evening plans. But any other questions before we do that? No? Okay. Well, we're pretty much on schedule. John, did you want to make your announcement now? I thought it was out. Did you not want to? I'm sorry.
No.
Whoever's going to Pinstripes for dinner tonight?
Okay, great. Hope to see you there.
Have you been to Pinstripes?
All right. All right. Thank you.
you want to do radio show? Yeah.
What is pinstripes?
That's like a bowling alley.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.